conferences. Get your questions ready, if you would, please. I just wanted to address a couple of things. Michael's book is worth a whole lot more than 1 cent. So I would recommend that you get that as well. And if the income tax were in as good shape as Mortimer Kaplan is, we'd be better off. Perhaps to put some air back in the balloon, although the income tax has taken quite a beating here, I wanted to ask Jared's question, if I could, of the panel members. Is there a chance for 86 tax reform anytime soon? I think I know Michael's answer. He gave it to us. Mine, you can sort of tell from my remarks, I would say not in the next 5 years, at least. But Joe, you're the historian on the panel.
I'm not inclined to think that 86 style reform is likely to happen, or even really that it should happen, because I think revenue neutrality is not the name of the game anymore. As I think all the panelists have agreed. We're looking for more money going forward in any reasonable scenario. 86 reform might be part of that, but it's not the whole story. I do want to say that I think Professor Gratz's idea of plausible reform, that is one of the most sensible paths of tax reform open to us at this point, and historically plausible as well, because it doesn't involve these ridiculous, rip it out by the roots and replace it. It involves introducing something new, which can do something, can solve some of the existing problems without tossing out the old. I do think it's still got plenty of political challenges with it. It does harken back to the 1913, sort of 1920s kind of income tax, but it sort of undoes everything of the post-war income tax, which is pretty deeply rooted. This mass income tax in which we all see it as like a shared responsibility, I think it would be hard to recharacterize the income tax now as something just for the rich. It did definitely start that way, but there's been a lot of water under that bridge since. So I'm not quite sure exactly how we get from one to the other. I will just sort of finish up by saying that I think Jared makes an interesting point here. Part of whatever tax reform we might pursue in the future, or tax replacement, or any kind of major tax change, is going to require a very strong affirmative case on behalf of taxation. That's something that's atrophied in the last 40 years. It's come back a little bit. I would say that Barack Obama has given us about a 20% of an affirmative case for taxes. But it's ultimately, I don't think, going to be it's not a persuasive case, because if the answer is we need more money, and we're not going to just get it from the rich, part of this deal, it's really got to be a package deal. I think you sort of squander your opportunity when you spend a lot of time raising taxes a little bit on very rich people. That's best packaged with a more important tax reform that raises money from everybody. And I think it's not just a matter of atmospherics. I think if you're going to go to the country and say, look, we got some challenges, we got some opportunities, we want more money to accomplish these things, you got to go with a comprehensive package that says, look, there's plenty of room on the high end to raise taxes. Let's do that. At the same time, shared sacrifice, civic republicanism, whatever you want to call it, there are all sorts of little buzzwords. At the same time, the rest of us are going to have to pay more too. And you're never going to sell that by itself. You need to sell it with the progressive style tax reform. I do think the Obama administration has wasted a great opportunity here. Also in the context of healthcare reform, I think this notion of earmarked taxes, certainly if Social Security or Medicare is not as good an example, but if Social Security is our model, this kind of earmarking for taxes is very politically powerful. There was an opportunity for that with healthcare reform, and I think, again, we kind of squandered that with a bunch of small bore, small change sorts of tax increases to try to pay for it. We would have been better off using that as an opportunity to say, look, I'm going to give you something big and new. We're going to need something reasonably big and new to pay for it. So,
I want to be, I should have been more precise. I was not thinking in terms of 86 as a revenue neutral reform where you buy off points with a broader base. I was thinking more of very partisan groups somehow coming together and implementing the kind of reforms that Joe stressed and Michael has elaborated many times. What I would consider very healthy tax policy and a very healthy tax debate, very different from what we have now. I don't have to say much here because I totally agree with everything Joe just said. I guess I would add only the following. First of all, we are very, very, very far away from that kind of consensus as I see it, answering the question that I posed. The title of my talk was something about what's wrong with, what's right and wrong with the tax system and the tax debate. I mean, the debate is, at least in Washington, maybe I'm very centric because I'm here, maybe it's better outside, people should tell me, outside the bubble, but here, the notion that anybody and Democrats and Republicans contribute to this, as Joe just, the notion that anybody other than, the filthy rich should have to pay another cent in taxes for anything, and then there's a group who say even the rich shouldn't have to pay anymore, is deeply, deeply embedded in ways that I've never seen it in decades of following this. I do think that it is partly a function of the lack of tying the benefits of the tax system into the cost. The thing that bothered me about Bob's talk, which I thought was interesting and provocative, was it's all costs and no benefits. And I think I don't think the evidence supports the kinds of costs to even the current system that Bob was elaborating, although the theory does. I think you have to. So the tenor of the debate would have to really change very seriously until we could get to the kind of outcomes that Joe described. I frame them as kind of we're in this together versus you're on your own. And when we're in this together, which is a phrase the President has used, the kind of reforms that Joe mentioned, the kind that Michael has elaborated, actually flow from the idea that we're in this together, we have to contribute to an economy and a polity that we share. If you're on your own, then everybody's taxes should be cut to the bone because the whole thing is broken and it doesn't work. Here's a voucher, here's a zero taxation on capital income. Good luck, go out there and do your best in a free market. I don't think that's realistic.
Anybody else on the panel?
Tax reform? Any other jokes? No. Not likely.
Okay, I'm going to have a little trouble seeing, so try to help me out. So the first hand over here, we have, the microphone is coming.
I heard
Bruce,
all.
I'll get to you next.
I'm sorry.
I'm sorry.
I heard all of you.
Sir, tell us who you are.
My name is Steve Hankin. I'm a recovering tax attorney. I heard all of you mention the word fairness, and not one of you made any attempt to define it. And in my opinion, what's fair about somebody paying more for government services, which I assume is the first function of any tax, to pay for the government services that you receive? And the fact is that people are paying far more than the government services they receive. My point is that fairness should be, what is fair is paying your fair share for the services you receive. And you guys are saying, oh no, now that's not fairness, apparently. I'd like your comment on what you think fairness is. That's my definition of fairness.
I'm going to just, I'm going to duck that question entirely, but I think convincingly.
You wrote a book about it.
No, well, because here's the answer. You have a very plausible definition of fairness in mind. I'm sure if we polled the audience here, we'd come up with about 30 or 40 other equally plausible definitions of fairness. The only way to answer those questions ultimately is a show of hands. And when we do that show of hands in this country, we end up historically, and I think even right now, with a progressive tax system, with the income tax system, actually. It may be wrong, but it's ours, and we created it. So I'm not disputing whether your notion of what's fair is right or wrong. I just don't think that in many ways any individual's understanding of that is relevant. It's the collective vision of it as expressed through democratic politics that matters.
So I would say two things in answer to your question. One is, it's not fair to pay 25 cents for every 40 cents we're spending and borrow the rest in a circumstance where the borrowing is pledging assets of future generations, not to Americans, but elsewhere, so that our debt after the Second World War was at a level which it's now approached as a share of the economy. But after the Second World War, the debt was owed 95% to Americans. Today, the debt is loaned less than half to Americans. And so we have basically said we're going to fund our consumption today, including our government, the consumption that runs through the government, through borrowing abroad. And so that is not fair. And so the idea that you can sit here and say, well, we're only going to have 20% of GDP in taxes and we can't have any more, but we want a government that's going to provide 23 or 24% of GDP, that's not fair. That's really not fair. We've got to pay for what we get. So even on your metric, I think we need to move forward. And then the second thing that I really I just want to underline a second point, and that is that Jared makes the point that the inequality in income, and here I think there are two pieces of the inequality that are very important. One is the tamping down of wages below the top 10% or 5% because of the competition, unprecedented competition for labor wages in the world. That is, I can have Corning manufacture the glass and have it put on my iPhone in a very low wage country. And so there's a huge amount of pressure in the economy that's keeping wages from growing in the bottom 80%. And on the other hand, there are opportunities for wages and non-wage income that have benefited the top 1 or 2 or 3%, or however you want to characterize it, in a sort of unprecedented fashion. And I thought Jared's point was important, which is you can't have a tax system that makes that worse. And you need to have a tax system that makes that a little better without hampering the ability of the economy to grow. And then I think the other point, which is an important point, is the FDR point that Joe just raised, which is that, think about FDR, think about John Kenneth Galbraith, who insisted that the problem of progressives in the U.S. is they're only looking to progressivity in the tax system, and they're not looking to what it pays for. The genius of Franklin Roosevelt was that he created a system that was very progressive, but he financed it with a tax that is not. He financed it with a tax that's actually regressive. But the system as a whole, if you look at Social Security, is actually a progressive system, and there is, I think, in the country, a commitment to a progressive distribution of government's resources.
Your first response, I thought, was you were really applying a collectivist view of fairness, and my point is fairness has to be defined by the individual taxpayer, not some amorphous collectivist view, and that's basically the first opinion you gave.
Yeah, let me move on to the next question.
Yeah, well, I'm glad Ayn Rand was represented here today.
Tell us who you are, Bruce.
Yeah, I have a question for the panel. Oh, I'm sorry. I'm Bruce Bartlett. I write for Tax Notes, among other publications. I think the panel would probably agree with me that there's been a deterioration in the quality of tax policy over the last 25 years. And I think one reason for that, and this is my question, is I think there's been a deterioration in the quality of the economic analysis of taxation over that time period. I mean, there were many great studies of the Kennedy tax cut that I studied when I was drafting the Kemper-Roth bill in 1977. There were many great studies of the 1978 capital gains tax cut. There were many, many good studies of the Reagan 1981 tax cut. But a couple of years ago, when I was writing a piece for Tax Notes about the economic effects of the Tax Reform Act of '86, I was just shocked at the paucity of analyses, because everybody in 1986 thought this was going to have a huge, massive effect on the economy. Some thought it would be good, some thought it would be bad, but everybody thought it would be big. And the consensus view expressed in the one major article I know of, which was Auerbach and Slemrod in 1994, said it didn't have any effect at all. Shuffled a lot of money around, changed the names of certain types of income, but it had no discernible macroeconomic effect one way or the other. Didn't affect jobs, didn't affect growth. And there's been, to my knowledge, Jared, correct me if I'm wrong, no really serious analysis of the 1993 tax increase, which every Republican on earth thought was going to crash the economy, create a massive recession. It obviously didn't. Now, one could even reasonably argue that it raised growth, but you don't even have to make that argument. Clearly, it didn't depress growth. This is unquestionable. Yet today, there are many, many people who will assert, as if it's just obvious.
You're excellent. So finish up, because I want to speak.
It's obvious that any tax increase, no matter how tiny, would have a massively negative burden on the economy. And finally, we have the more recent experience with the Bush tax cuts, which were supposed to massively increase growth. And my friend Glenn Hubbard swore to me up and down that this was going to have a massively positive effect. It had no effect at all, and arguably a negative effect. But there are no serious analyses. And I read, tax notes regularly. I read the National Tax Journal regularly. I'm looking for articles by economists better than me, which is all economists, and explaining this stuff. And I'm just wondering, is this a source of our difficulties, that the economists have kind of fallen down on their job of analyzing major changes to the tax system?
Well, so first of all, let me say that I don't want to speak to your quality as an economist. I think you're writing some of the most interesting stuff about everything we're talking about here today. So whatever you're doing, keep doing it, because you're making a great contribution. I completely share everything you just said, and I am slightly befuddled by it. When the payroll tax break was about to be allowed to expire a few months ago, I was getting lots of inquiries as to what the economic impact of this tax was and what it would be if it went away. I could not find one study. This is $120 billion of a tax cut per year that had been in place for a couple of years. We have more and better data, more and better econometric methods. I could not find one study. There is one now, and it shows that the measure was helpful. So, but what you end up with, and if you look at today's front page of the Wall Street Journal, is journalists kind of making a lot of phone calls to people like you and me who say, I think it's probably pretty helpful, and or not, and our perspective comes from our background, our ideology, or for the most part, from plugging numbers into macro models and saying, well, according to my macro model, if you add $120 billion to government spending at a time when the economy is at a zero lower bound, and et cetera, you're going to get 0.5% of growth, or in this case, probably more than 1% of growth, and that's going to be more than 1 million jobs. That's the state of the knowledge, and your complaint is also historically correct, because there was a time when empirical economists actually used to get into the data and look at what it did, and I don't really understand why there's so much less of that now. I recently read with great fascination this article by Peter Diamond and Emmanuel Saez about optimal taxation, and it was excellent and interesting and all purely theoretical. The comments that were made on the panel today, I thought some of the comments that were made on the panel today fell into what I would consider a trap that you very well articulated, which is this idea of large responders versus small responders. You can easily think that tweaking the tax code a tiny bit, or for that matter, tweaking the minimum wage a tiny bit, has cataclysmic effects or wonderful effects. And the history of the empirical evidence is really much like Bruce summarized it. So I'm very much a small responder. I think we way overdo what we think these impacts will be. but I no longer have the data and empirical analysis I need to make that case. So all I can say is you're right, and I would hope that economists would be listening to the critique you just raised.
We've had several questions from Twitter, so why don't we take one now?
Thank you.
Are we ready?
Yep. This question is from Mary at Sage. Is there a way to simplify the tax code and ensure it remains simple without changing the legislative process?
You have any thoughts on that?
No. Mary, the legislative process is probably the biggest problem there. If there's any way we could bypass it entirely, like the Chinese do, that would be, you know, I'm not suggesting democracy is overrated, but People's Republic of China, they don't have debates or filibusters or things like that. They want to raise taxes, they raise taxes.
Yeah, and following the Tax Reform Act of 1986, I think it was 1988, they came up with a law called the Technical and Miscellaneous Revenue Act. That is what it says. Just a whole bunch of junk they added back into the tax code. So
I'm more optimistic than this. I have to say, I think that the country responds when it is told what it needs to do, and the legislative process will get together. You know, the 86 Act, all the smart money was it wasn't going to happen until it happened. And it happened because of the courage of a handful of legislators who were not obvious people for making the kinds of changes they did before they did it. I mean, afterwards it was easy to say, you know, that Bob Packwood and Dan Rostenkowski and so forth, you know, had gotten together and done this for the country. And, you know, they weren't, it just wouldn't necessarily have thought that they would have going into it. So I think we have to remain optimistic. I think that politics can only stay broken so long. I will say that, and this goes back to something Jared said about the Democrats. So I lived through the 90 Budget Act when George Herbert Walker Bush knowingly put at risk his second term in order to solve a budget crisis and broke what was his most visible and most important political promise to the American people. And he did it for what he saw as the good of the country. And having been in the room, I can tell you he did it knowingly and willingly. It wasn't what he wanted to do, but it's what he did, and he did it because he thought he had to do it. And he came together with George Mitchell and Tom Foley and a group of others to produce the 90 Budget Act, which actually led to the 93 rules, which led, I think, in important ways to the surpluses that we had in 93. So people will exercise political courage when they need to and when they see that they will. One of the things that I cringed, and I know George Stephanopoulos cringed at the same moment, was when I was watching the Philadelphia debate between Hillary Clinton and Barack Obama. And they both promised not to raise taxes on anybody below $250,000. And George Stephanopoulos said, now is that a read my lips, hearkening back to George Herbert Walker Bush's pledge, is that a read my lips pledge? And they both basically said yes. And to, I think the cost of the country. Barack Obama has insisted on that pledge and continues to insist on it even today when he's no longer running for office. And it is true, I mean, it's like a Bill Clinton moment on Law and Order where you had an issue that was a Republican issue and Bill Clinton took it away in the 92 campaign by saying he was going to put 100,000 policemen on the street and so forth. And Barack Obama and Hillary Clinton decided that they couldn't leave the anti-tax issue to the Republicans. It had been the centerpiece of the Republicans' political platform. It had been the glue that held the Republican coalition together, and they were going to break through it, particularly in the middle class, by making this pledge. But it is a problem when the President of the United States limits himself or herself to taking something that's that important off the table for the future of the country. And so, you know, he couldn't. I mean, Joe talked about the health care thing. He couldn't say, I'm going to put in a 5% value-added tax in order to fund universal health insurance, because he had promised the country he wasn't going to do a tax that applied to middle-income people, even if the spending was going to make them much better off in the aggregate. And so I think the legislative process will adjust, and that we'll make some progress. But I'm worried about what's happening in the interim. I'm not pessimistic over the long term, but I'm very pessimistic over the middle term. And I have to say I'm very concerned about what we might do to ourselves in the interim.
I think that's right. Mr. Kaplan.
I'm Mortimer Kaplan. I still practice tax law with the Kaplan and Drysdale, and I was in government during the Kennedy years, which is really my theme on reacting to this panel. You know, Kennedy came out of World War II, as I did, and there was a lot more patriotism in the air, and a question of obligation to country and loyalty. And Kennedy early in March of 1961, he made a special speech to Congress, a tax speech. And he called on the country. He said a strong tax system is essential to a strong democracy. And that was kind of the theme, that this was sort of an obligation of everybody to support the tax system somehow. And the Internal Revenue Service at that time had a different function. A lot of it was really selling to the American public the importance of compliance with our tax laws. And that's why Michael and I disagree so much. I think that everybody should file a tax return, and below $250,000, part of this price of citizenship. And I go along with the idea that while the federal income tax law, how old is it, 100 years? The IRS had its 100th birthday while I was there. Went back to Abraham Lincoln. He started the IRS and the Commission of Internal Revenue. But I do think we're going to have some additional tax, some form of value-added tax in addition to the income tax. We'll have to face that. And I think President Obama may have to modify his pledge.
I'm having trouble seeing. Over here? Hey.
Hi, I'm Diane Lim, formerly Diane Lim Rogers, formerly of the Concord Coalition, now at the Pew Charitable Trust. So I thought I'd take this opportunity so people can find me now. I wanted to speak as a tax economist who's modeled the effects of tax policies before. I think that Bruce described the Tax Reform Act of '86 and the tax increases in the Clinton era. And I think of those two tax changes as very different. The big difference being Tax Reform of '86 was revenue neutral, and the Reagan tax increases were not the kind of tax reform that economists like to study at the time. So when you think about the Tax Reform Act of '86, everyone had really high hopes for it in terms of the economists thought that it was changing all sorts of incentives. It was improving incentives to work and to save and reducing the distortions of the income tax system and economic behavior in general. And that was in the heyday of general equilibrium modeling where, you know, we could do anything as long as it fit in a revenue neutral framework. And we could measure substitution effects and how big these excess burdens of the tax system were. Well, you know, after the Tax Reform Act of '86 and people started looking at those margins and how big these effects were, you know, most models had to assume elasticities. So, you know, you kind of made up how big of a story you had. But those who actually carefully tried to parameterize the models, like Auerbach and Slemrod, came up with the conclusion that, you know, all those effects that economists get all excited about and put bells and whistles in their models about, they're really small. So people like me, who I was building these big, gigantic models with bells and whistles, I got a little discouraged. And, you know, I realized I was intentionally shrinking all the elasticities in my model to reflect reality. In the end, if you reduce elasticities to 0, you don't need the model anymore. And you know, it becomes sort of a silly exercise. And instead, what we learned with the Clinton era tax increases, because I was working at the Council of Economic Advisors at the time, at the end of the administration, was that, you know, income effects seem to matter a lot more than substitution effects of tax policy. So whether you're raising revenue, not raising revenue, or even losing revenue seems to be much more important from a macroeconomic standpoint than whether you're reducing a marginal tax rate here and raising one there and creating some difference in the playing field, but still raising the same amount of revenue. So that's why I think we don't have like really great models that capture both the substitution effects and the big macro effects. And so that's why there hasn't been a lot of work that accounts for every possible economic effect of a tax policy change. But I think the good news is that you don't need fancy models to be able to figure out that a revenue increase, for example, may not actually hurt economic growth, and in many cases can help because it raises national saving. It raises private saving more than it reduces. It raises public saving more than it hurts private saving.
I want to make a comment about that. First of all, it is interesting, one of the things you said, which I thought was candid, showed a lot of candor, was, you know, the idea that a lot of economists in this research are looking for big elasticities because, I don't know, it makes you feel like you found something. There's like you know, a bias. There's a bias in the method. And in fact, if you look at the tenor of the debate today, it still is, as I said before, it still is revolving around huge behavioral responses. And I think that's fundamentally wrong and dangerous. Now, one of the most important, I think, in the sense of actually moving debates in big ways and influencing the country politically, influencing the outcome of the last election, one of the most important bits of research was the Tax Policy Center's analysis of Mitt Romney's plan that he could pay for his tax cuts by lowering, you know, closing some loopholes or lowering deductions on a fairly restricted sliver of the income distribution. So the Tax Policy Center got together and crunched a few numbers and showed that, in fact, you know, that was mathematically impossible to do. It's just the tax cut couldn't be paid for with that kind of a thing. That, to me, was an example of actually very solid, simple research that had, as I understand it, I think probably zero behavioral responses built into it. And I actually think that that is, in part, the way forward. We can't give up on the elasticities. They exist. They're real. Perhaps income elasticities are larger than substitution ones. And if that's true, the literature certainly doesn't reflect that. Most economists who do even the theoretical research just ignore income effects. So, you know, I think the recognition that the elasticities are small is not a bad thing. It's a really good thing because it gives us a lot more oxygen in terms of the policies that we can think about implementing without unnecessarily freaking out about behavioral effects.
Let me take one from Twitter.
This is from @BrashTax. Is tax reform possible without a detailed White House proposal, i.e. Treasury 1 and 2?
You know, I guess I'm the one to answer that. I think that what Chairman Camp is now doing, which is putting out important ideas, which he's done himself in international taxes and in taxing financial instruments, and creating a set of working groups across the aisle to study other issues is an important step. And the reason I think that Chairman Camp has moved in that direction, and I wouldn't be surprised if the Senate Finance Committee decides that it needs to do some similar kind of work, is that the Treasury Department has not put forward the kind of analyses that it did going back to 1968, 1977, I guess, is when David Bradford's blueprints for tax reform came out, 1984, 1986. I would say 1992, when the Treasury put out a very important report on corporate tax integration, which still I think is important when one thinks about the taxation of pass-through entities, large pass-through entities, and corporations and so forth. The Treasury just has not been doing a lot of that lately, and so it has to come from somewhere else. I do want to plug the work. Since I don't like to enter into economist debates, especially when they are berating themselves as well as they have. But I do want to underline the importance of the creation of the Tax Policy Center, the funding of the Tax Policy Center, and the ability of the Tax Policy Center to tell us something quickly about a whole series of ideas. I think a lot of good economists that were at the Treasury for a number of years are at the Tax Policy Center, and it is a very interesting joint venture which has produced some very important work. As I say, I'm particularly grateful to them and the Pew Charitable Trusts that they took a plan by a private person not running for president and analyzed it. I'm not, certainly not. But I do think it is. I do think it is an important gap filler in the way that I think what Camp is doing is something of a gap filler, and that you'll see more work filling gaps. Part of the problem, I think, with this administration and to some extent the previous administration is that tax policy has become such a highly charged political issue that the tax policy decisions are being made out of the White House. And so for the first time in history, we had a full presidential term without a Senate-confirmed Assistant Secretary for Tax Policy, who is described in the Treasury delegation orders as the administration's key spokesman on tax policy. So that tells you what's happened to the Treasury Department as an institution in this, and I think that's a big problem. So I think it's an important question.
David?
Is this on? Yes, it is on. Thanks, Chris. My name is David Berdori. I'm with Tax Analysts. We have some students in the room, and I want to encourage you to read Professor Gratz's book, The 100 Million Unnecessary 100 million unnecessary returns. It is bold thinking, and it's eye-opening. So I would encourage you to do that. I have one comment and a question for Jared. My comment is, and it's something in response to the first questioner, the issue of fairness in the income tax, I think, is a legitimate question, because the president during the campaign must have said 1 million times, we want to get people to pay their fair share, people like me to pay their fair share, people like Mitt to pay his fair share. We do not have a definition of what that means, in all honesty. And I think that is a legitimate question about what we're talking about, because Joe more than implied that this is a collective decision about what is fair, which means it's a political decision, and that's fine. But we should recognize that there's no principle involved. It's what we decide is fair is going to be fair, and that's fine. What's that? Oh, of course, absolutely. But I think it's a legitimate question to be asked. My question for Jared is this: I think you said that you would be in favor of, I don't know if you use the term earmarking, but dedicating tax revenue to specific government services. I believe, and it's not really news to anyone, Americans want a lot more government than they're willing to pay for, as we've experienced over the years, and we all know that. My question is it possible that if you actually asked people to pay for those services they were getting, they'd want less?
Great questions. First of all, on the fair share thing, I think all the president was saying, by the way, because at the level of campaigns, I don't think you can get too complicated. I think what he was saying is it's not fair for very rich people to have a lower effective tax rate than far less rich people. That's all he was saying. And I think that at a first order blush, we would probably all agree that, you know, that would fit into most people's definition of what's fair and not fair. At the core of, I hope, my comments, at the core of, I thought, Michael's comments, and really all of ours, Bob and Joe's as well, and Chris mentioned this, so all of us, I think is this point that you were getting to, and that we've all stressed, and that this 250 threshold vitiates, and that these huge response, I think, fantasies vitiate, is that if people are disconnected between what they're willing to pay for and what they get, our tax system can't survive in terms of legitimacy, fairness, or providing the kinds of revenues and services and protections that an advanced economy needs in this century. So I think that it is critical to reconnect, and Mort said the same thing. I mean, he put it in terms of patriotism. I think it is critical to reconnect paying for what you want with a tax system that collects that revenue. If that leads to people saying they want less, my gut instinct, answering your question, is it probably would to some extent. If that goes there, then so be it. You know, I'm okay with that. I think that the ultimate conclusion is going to be much like Joe's description of the fairness, some aggregation of what you want, what I want, and what everyone wants. But what you can't have is a majority wanting a bunch of stuff that they want a minority to pay for.
I hear the cake's arrived. I've got a secret. The idea for the cake was Bob's. So knowing Bob to be a generous person, I know he would prefer to celebrate the 100th birthday of the income tax before we bury it. So we're running out of time. I want to give each of the panel members just a couple of minutes if they want to sum up anything. Michael?
Yeah, you know, I want to say one more thing about the international conversation that Bob raised, because I don't think we've said enough about it in the following sense. And I'll just make the point briefly, and that is that the U.S. has a very large market. We have a lot of consumption that is occurring here. And what we're taxing when we tax income is we're taxing production, which occurs here. And we're not taxing production that occurs abroad, because we're not taxing imports that are consumed here. Somebody else is taxing imports that are consumed here. The economists tell you, well, this border adjustment doesn't matter economically because currencies will adjust. Well, I'm not so confident, for example, that the Chinese currency is going to adjust with market forces, but that's neither here nor there. And now that the Europe economy is as linked on currencies as it is, you've got great distortions, because the Deutschmark ought to be a lot more expensive than the Italian lira, but they're both the same price. So currency markets have become complicated. But the point that I want to make is that I think in terms of taxing the business results, we need to think about taxing on a basis that takes advantage of our market and our market power and our consumption ability. And if we can't do that politically directly, we're going to have to start thinking about ways to do it indirectly. For example, if you look at the problems of international income shifting, which Bob is so concerned about, what you find is that those U.S. multinationals that have been in the press are paying a much smaller share of their worldwide income taxes. They're paying less income compared to worldwide income than they are than their sales. That is, they have that if you just aligned, you know, their income with their sales, you'd get a lot more tax. Now, there are problems with that under both the WTO and under our income tax treaties, and there are a whole series of issues that have to be unpacked. But if we're thinking incrementally, I mean, I'm a person that believes we really need to make a big shift, but if we're only thinking incrementally, I do think we have to start thinking more about things that don't move. And we talked about workers and we talked about capital, but we didn't talk about consumption. And I think if you're going to think about that, this is an important issue that didn't get raised to the level that I think Bob's earlier comments required us to talk about a bit more. So that's a different point, but I think it needed to be made.
Certain things are inevitable. We need an alternate revenue source. It can be a VAT, it can be a carbon tax. Pick your poison. Read Joe's book, read the professor's book, and read Worldwide Tax Daily, so you're well informed.
Can I just say one thing about a carbon tax? I did a book on energy policy in which I said you need a carbon tax instead of cap and trade. I think there's great advantages of a carbon tax instead of cap and trade. But I think because of the regressivity of the consumption of energy, that you're not going to get a lot of revenue out of a carbon tax, that you ought to think about a carbon tax as energy policy and not as tax policy, and that Maria Cantwell's proposal for a carbon tax and then giving it back on a per capita basis may make some sense, or giving it back in the way that the Center on Budget and Policy Priorities wanted to give it back. I think there's much less revenue for general purposes or for earmarking or whatever you want to do in a carbon tax than there is in a much broader-based consumption tax.
Yeah, carbon tax shouldn't even be about the revenue. It should be about capturing the externality.
Exactly. It should be about energy policy and not tax policy.
Bravo.
I kind of gave my summary, thematical comments a second ago about the importance of tying the tax, reconnecting the tax system back to what it pays for and what that means to people. So let me just take a minute to talk about, just very briefly, two current events that I think have bearing on where the debate is headed. Actually, if I were talking about really current events, we'd talk about this sequestration silliness, which amazingly hasn't come up, which is a good thing. So we've had a little bit of a respite from that. I just want to say that in any tax reform measures, whether they're big or large, that come up, there should be virtually no distinguishing between spending through the revenues we collect or the deficits we borrow and tax expenditures. Tax expenditures are nothing more than spending through the tax code. And if Republicans truly believe we have a spending problem, as they like to say all the time, then they also believe we have a tax expenditure problem. I think that logic is important and correct. Given some of the discussions around the panel today and all the lobbying that goes on in this town, it's probably a lot harder to close loopholes than we may have made it sound. That's why I think the president's idea of a cap on deductions, he has a 28% cap on deductions, of course, just for $250 and above, and we've already talked about that. But the idea of capping on deductions does seem like, to me, a more streamlined way to get at this issue of claiming you're not a big spender by just passing tax expenditure after tax expenditure.
Joe?
I'm really just going to repeat some of what has already been said, and particularly by Jared. But I think that the theme here that has emerged for me, and I think we all share, and Moore Kaplan shares as well, is this notion that what we really have here is a crisis of government and of governance, not really a crisis of the tax system. And that if there's a rule that comes through from, there are many rules that come through from tax history, but one of them is you got to sell the government before you can sell the taxes that pay for it. And what we've had over the last 40 years is a crisis in the faith in government. So that's really the first order of business. We're never going to get real tax reform, the kind of tax reform that solves big problems rather than little small bore problems. We're never going to get that, until we restore this faith in government, whatever that takes. Changing government, downsizing it, upsizing it, whatever it is, we have to restore the faith in it. I think the Obama administration, President Obama in particular as a person, has gone some distance in that direction, but there's plenty of work left to be done. And that's the foundation that all tax reform ultimately is going to be built on.
Okay, on that note, thank you all for coming. And thanks to this magnificent panel, my job is very easy. I get to sit here and listen to them and have a piece of cake on Tax Analysts.
Excellent, Joe. Excellent as usual. Ross, excellent as usual.